Here's the fun part. Let's talk about distributions, return on investment. How soon are we going to get paid, right? And the answer is as soon as we possibly can, responsibly, and as soon as the deal can support it. So if we're dealing with just a little bit of vacancy or a building that's already pretty well stabilized, we might be able to distribute immediately. On my most recent deal, it took about a year to get it fully leased up and stabilized to the point where we had enough excess cash flow that we could start making distributions to the ownership group. And so that largely is going to depend on how much vacancy we have in the deal, what we're buying it at, how much cash we have in reserve. Again, we don't want to bleed a deal, but we must make sure that we can responsibly distribute, as much as we can, as fast as we can, while we're taking advantage of all the other profit centers. Probably one of the most rewarding things about real estate, and especially commercial, is that we're stacking multiple profit centers together. So in this case, we're going to be enjoying quarterly cash flow as soon as we can start making those distributions. We've also got forced appreciation occurring. So every time we sign a lease in the property, we're increasing the value, by whatever cap rate that's at. And so, I can sign a lease and increase the value of a building by $500,000 to $1 million in a lot of cases. So that happens in a moment. On top of that, every month, the tenant is paying their rent, we're paying our mortgage, and we're building up equity as we pay down that loan, on top of the tax advantages that exist. So we're gonna have things like depreciation, which in many cases can provide us with even more net operating losses, depreciation, phantom income. So we get that through a K1 that flows through to our personal returns. So you might have a negative 100,000 on K1 with $100,000 of income that could potentially zero out someone's tax liability. That's gonna be a question to check with our CPAs on, but that's been the case for us and a lot of our investors who participated with us on deals. So when we're doing any deal, what I'm gonna be looking at is the scenarios and basically what's the timeline look like to get a building fully stabilized? What are some of the capital events that might occur? And there's basically a couple of options here. We sell the building and realize this nice profit from buying it 50% occupied, filling it up, and now selling it to someone with a much larger income stream, or doing a refinance where we increase the value of the building, go back to the bank and say, hey, the property is worth double what it was when we bought it. We'd like to do a refinance, pull some cash out of that deal, which could give us the opportunity to return some or potentially even almost all of our initial capital back. So this is that beautiful scenario where we're getting into a deal with no money out of pocket. You buy it, you increase the value, you pull that cash back out, and now we move along to the next deal while still maintaining positive cash flow and all those other profit centers that we were talking about. And so this is a scenario here. I think we were able to return 60 or 70% of someone's initial investment back to them at that refinance. And so that could happen in 6, 9, 12 months, depending on how well we do with the lease up. And that's probably the most rewarding part of this whole business. I get to go back to, my friends and my colleagues and say, hey, we signed a new lease. We got the appraisal in. We're able to return this much capital. We sold the building, for twice of what we bought it for. And that means that everyone is going to get this type of return. Historically, those have been compelling and exciting. Otherwise, I wouldn't be doing the deals. I think I'm not going to greenlight a project unless I can deliver to our investors, conservatively double-digit returns. Think 15, 20% has been pretty typical on these last couple of projects. Obviously, I can't guarantee those types of returns. All we can do is look at all the things, mitigate the risk as much as we can, give ourselves the highest probability of success, pass on 99 out of 100 deals to find those unicorns where we are going to be able to make those outsized returns, with relatively low risk profile.